All right, looks like we've got Kathy here. You're my first participant. Can you hear me? If you can hear me, say something in the chat while I fix my hair. Hey guys, looks like we have a few people here. Everybody's showing up. Raise your hand if you can hear me. Got Chastity, Chris, Rebecca, Suzanne. All right, Chastity raised her hand. Where is everybody tuning in from today? Put your city in the chat box. We've got El Paso. Of course, we're here in Austin. Everybody else is on mute. All right, I'm gonna turn my phone off. Okay, great. Everybody's showing up. Jacob, welcome everyone. Some music in here. Oh, Jacob from QL, right? My little QL graduate. Is that who you are? Knudsen, I recognize the last name. Yeah, glad you're here. What are you guys hoping to get out of today? Go ahead and see if you can use the chat box. See if that chat box is working. All right. Chastity says she wants to learn more about investing smartly. Okay, great. Chastity, do you own any investment properties? My hair is like fly away today. Jacob, anything I can. Okay. Well, this this seminar today is going to be a little bit more focused on opportunities that we might have instead of. I know I kind of touted it as an investing 101, but I thought it'd be useful to really talk about opportunities that might be out there. All right, we got other people showing up. Dion's here, Destiny, Leanne's here. Hey, Leanne. Suzanne is here. Go ahead and let me know where you're tuning in from. Put your city in the chat box. If you're too shy to share your city, why don't you tell me what you had for lunch? Rockford, Illinois. What's the weather like in Rockford right now? Oh, Sioux Falls. Hello, Sioux Falls. You know, I'm from Fargo. North Dakota. Rebecca says it's hot and steamy. I know. I'm going to Minnesota in a little bit, and I hear it's not that nice. Irving, Texas, of course. Hello. I know. Well, we have all this Sahara dust, right? Dion, I think that's what that is. It's all the dust. Oh, hi, Mauricio, Austin, Texas. Nice to see you. Yeah, it's pretty steamy here too in Austin. I feel like I haven't been outside in a couple days. It's just too hot. All right, we got some more people showing up. Of course, we have 160 registered, and there's only 11 people here 3 minutes before it starts. So congratulations to all of you who are not only on time but early. You're the top 10%. Oh, Jacob, you're from Minnesota. Where in Minnesota are you from? That's real source for you. I know. There's a lot of our clients, but it's a lot of real estate agents too, unfortunately, or fortunately, either way. Jacob, what part of Minnesota are you from? You know, I'm from Moorhead, Fargo area. Yeah, Rebecca says they'd be early if we serve food. I know. It's sad. It's really sad. Sad, sad, sad. My team's not even here. There you go. Okay, Wayzata. Okay, nice. It's a nice area. Oh, Angie's there. There we go. All right, everybody's showing up now. It's 3:58. Oh, Mike is here. Patty, Sharita. Let's see who else is showing up. Aiden. Oh, hey, Aiden. How are you? Also from QL. You should connect with Jacob because you guys are both here from QL and you have a big interest in wealth building, so you guys should connect. Carolina. All right, Angie's here. Carrie's here. Kathy was the first one. Guys, go ahead and use that chat box. We're going to try to make this interactive. So tell me what city you are tuning in from today. Just go ahead and use that chat box and tell me what city you're tuning in from, so I can see who's here. All right, we got New Hampshire, Seattle, Baton Rouge. Probably pronouncing that wrong. San Antonio. All over the place. We got a few Texas people. A few Austinites. A few Illinois people. All right, people are just pouring in now. Jeffrey, Laura, Stephanie, Casey's here. Oh, Chris Hall's here. Hello, Chris. Dan Harker. Hey, Dan. Thanks for your nice message. Thanks for your nice email. That was really sweet. Appreciate that. We've got Giselle. Giselle, were you at QL also? Okay, Jacob says, do you want us sending chats to just panelists or panelists and attendees? Oh, I see. Is it only to panelists? I think you can send it to all attendees. It's just something that you can choose. Yeah, some people are. It looks like maybe everyone is a panelist, though. I don't know. All right, Dan's here from Dallas. All right, Sharita's here from Pearland, Houston. COVID's getting bad over there, right? Hope you're staying safe. Hope you're staying safe. All right, Aaron's here. All right. Dory is here. Aaron, Jeffrey, Karen, Laura. Oh, Quandell is here. Another my QL friend. Stephanie, Suzanne. Oh, Susie. Hey, Susie. Long time no chat. Also a QL friend, technically. Okay, yeah. Giselle was at QL too. Yeah, so there's like three of my QL grads that are here. All right, it's 4:01 and we got about 40 people here. So congratulations, guys. You are the early ones. So we have about 170, 60 people signed up, and I appreciate y'all being on time. We do have a couple special guests here. I'm not sure Zander is here, but Leanne, oh, Zander's here. Hey, Zander. Glad you're here. So let's get started. It's 4:02, and you know what, guys? I'm actually going to go ahead and we're going to go live on Facebook, if that's okay. So give me a second just to make that happen. This takes forever. All right, going live on Facebook. Share in a group. For those of you that are in real estate, we're going to be sharing on the Pivot Shift Ahead group. All right, I think we're close. There's always a little lag. Can't exactly tell. Well, not now. All right. All right, talking about wealth building opportunities in the market. Okay, awesome. Here we go. Going live. Okay, I think we're live. Sorry, guys. Check that your stream is connected. Glitching here. It's not wanting to go live on Facebook. Turn up the volume. All right, I think we're live. Ugh, so I have an unstable internet. It's crazy. All right, here we go. Okay, guys, thanks for being patient. Anyway, I want to welcome everyone here. It's 4:04, and we said we'd start at 4 o'clock, so here we are. I want to introduce myself. My name is Wendy Papasan, and I run the Papasan Properties Group here in Austin, Texas. We also have a few expansion locations for our real estate team in Dallas, Texas, Houston, Texas, and Minneapolis, Minnesota. So shout out to all my friends there. And today we're going to be talking about favorite all topics, which is real estate investing. We're going to be talking about real estate investing. We're going to be talking about the economy. I've got a few special guests here with me today. I've got Zander Blunt, who is an incredible mortgage broker from Prime Lending. And I've got my friend Leanne Wortman, who's a green builder here in Austin and one of my favorite boss babes. So we're going to learn a lot. We're going to talk about opportunities in the market. So hopefully you guys will tune in. We're going to be running about 45 minutes plus questions. So feel free to jump into the chat box and just raise any questions that you guys might have. So I'm actually going to go ahead and share my screen, and we're going to pull up a little presentation that I have for you. All right. All right. So let's get started. I told you guys a little bit about Zander, and we're going to be talking with him a little bit later in the presentation, but welcome to him. So just a little overview of what we're going to be talking about today. We're going to start with an economic overview. Obviously, we're in a time of economic upheaval. There's lots of crazy things happening with the economy. We've got historic unemployment. We've got commercial real estate that's tanking. We've got residential real estate that's in some areas tighter than ever. So we're just going to kind of go over that and talk about what the future might look like. Then we're going to spend a little bit of time talking about today's lending climate, which is also just up in the air. We've got a very volatile lending climate that's going on. And then we're going to move on to what I think are some investing opportunities. Obviously, I don't have a crystal ball, but when I think about 2008, 2009, 2010, we were just kind of starting our wealth building journey. And boy, do I wish I had some money in the bank to take advantage of opportunities that were presented to me at that time. I did take advantage of some of them, but not as many as I liked. And I'm happy to say that we've spent the last decade really saving our pennies, waiting for opportunities. So I'm going to share with you what I think some of those opportunities are going to be, and how we're thinking about where we're going to possibly put some of our nest egg. And then we'll definitely take some time and answer any questions. All right, so I just wanted to first of all give you guys a little bit of an economic overview. I thought I'd start out with these great slides from CNBC that I found. So take a look at this first slide. This started in January 13th. They started tracking. This is change in requests for directions on Apple Maps, right? So you can see that baseline of January 13th, right? That's the baseline. And then obviously a drastic fall off in mid-March. And then we've got three things that we're looking at there. So we've got driving directions, walking directions, and then we've got transit directions. So prior to mid-March, obviously all those numbers are kind of, holding steady. Huge drop off in March because of the United States being shut down, and then you can see that transit line is still way below, but the driving directions are basically back up to where they were in January, right? So people are back out driving around, but definitely just not using public transportation for obvious reasons. All right, so this one, whoa, look at this one. U.S. restaurant bookings on the Open Table Network. Massive drop off in April, right? You guys, this is the restaurant industry. Climbing back up though, right? Who knows what'll happen, but definitely climbing back up in June. Only down 80% as opposed to 100%. Then we've got U.S. air travel. Yeah, again, unbelievable drop off. Really unbelievable drop off. And I have to be honest, I got on a plane last week. It was pretty interesting. The airports were actually fairly crowded. For those of you that live in Austin, it felt like Austin circa 2010. Those of you that have been here for a long time know that our airport keeps getting more and more crowded. And it was quite crowded, but not as crowded, like not 2020, but 2010. And what I understand is that, airlines they're running at a loss right now. And if they continue to allow that middle seat to be open. So I got on the plane and I was flying Southwest, and so all the middle seats are not taken. And it's my understanding that until airplanes can fill those middle seats, they're flying at a loss. So huge part of our economy. Here's the hotel occupancy rate. Interesting, kind of going up in March, probably because of spring break, and then a pretty drastic drop off. But again, coming back up. I didn't have an Airbnb occupancy rate. I know that fell off quite a bit, but I think that has also seen kind of a drastic uptick because people are more interested in kind of being in Airbnb than in a hotel. So the hotel industry isn't doing quite as bad as we thought, but huge employer, right? Massive employer. And then the last one we've got here is U.S. home purchases, right? So this is one part of the economy, and a lot of you guys that are listening today are either our past clients or you're probably realtor friends of mine. And you can see obviously huge drop off. And this is a year-over-year change in mortgage applications for single family homes, but really, honestly, right back up to where it was in February. So craziness. And then just as some historical perspective, this is from the Mortgage Bankers of America. And this is, again, mortgage applications, but this is a much bigger scope. So this is going all the way back to 2008. And so it's really the last 12 years of data. You can see that massive drop off in, April on the right-hand side of this chart. And then really we're all the way back up. And if you go over to the left here, not since 2008 have we seen this kind of mortgage applications. So we're basically at a 12-year high now. And a lot of that has to do with refinancing and interest rates and things like that. And Zander, if you're here, you feel free to jump in if you want. But we'll go to you a little bit later as well. I just think this is super interesting to get this historical perspective. All right, so want to introduce a good friend of mine who's helped many of our clients. His name is Zander Blunt, and he is going to talk to us a little bit about what's going on in the lending world. Let's see. I'm going to see if I can stop my share here. Zander, are you here? Are you muted? I'm going to allow you to talk. Uh-oh. It says allow to talk is not available because Zander is using an older Zoom. I'm going to promote you to a panelist. All right. There we go. Are you here, Zander? I can't see you. Anyone? I'm not even sure he's here. I'm going to make you the host. All right, what do we see? If he doesn't have the latest version, he may not be able to participate. Okay, great. Okay, Christian says that he can see and hear us, but we can't hear Zander. So anyway, we can let Zander jump in a little bit. So Zander, just jump in if you can hear me. I'm going to go ahead and share my screen again, kind of move forward, and then Zander can give us an update in a little bit. All right, so just jumping to what I think are some opportunities in our changing market. I really see those opportunities coming in three areas. All right, so that first area is really REO and foreclosures. With a show of hands, were there any realtors who did a lot of foreclosures or short sales or bank-owned properties back in, gosh, 2009, 2010. Well, I know personally in Austin, Texas, we didn't do a lot of those, and that's just when I was starting my real estate career. So I didn't have a lot to do with that. But there's a possibility we may see some bank owned properties. So what's happening right now is, for those of you that don't know, is the government has allowed banks to provide what's called forbearance to homeowners. And basically what that means is the homeowners do not have to pay their mortgage, or they're basically postponing paying their mortgage. And that can look like a lot of different things. And if there's anybody out there who's thinking about forbearance, you know, who's maybe struggling right now, who's one of the people who's maybe lost their jobs, or you've a spouse that's lost your job, I'd love to talk, because I've had several conversations with friends of mine who did a lot of REOs and foreclosures, and what they're telling me is that forbearance can be kind of a scary option for some people, because we don't know exactly what that looks like. So it's my understanding that forbearance can look like several things. It can look like, in 90 days you have to pay that money back, right? So basically you call your bank, you say, I need forbearance. And in 90 days they say, hey, we've given you a break for 90 days and now you need to pay that money. And for most homeowners who have suffered a job loss and they can't pay their mortgage, having to pay a lump sum in 90 days is not a great option. And so instead of maybe, you know, not paying your mortgage, there's opportunities to refinance if you've still got your job, or perhaps to even sell your house. So better than losing your home, having it go back to the bank, and then your credit really being destroyed. The other thing that can happen with forbearance is that you can have the repayment tacked on to the end of your loan. So for most of us, if we have to pay, you know, six.
Wendy. Relaunch. Well, I think if y'all can hear me, I'll continue since I wasn't unable to get on earlier. But I can hop in and speak to the lending side of things and where we're at until Wendy comes back on. But we've seen a huge uptick in purchases in the last 30 days. Basically, what we're seeing is the normal spring purchase season that we enjoy here in Austin and across the country was delayed due to COVID, and it's really kicked in here in June, July, August, and I think we'll spill into the fall. Interest rates remain at record lows, and we're seeing about a 300 basis point spread from Fed's rates at 0 to what 30-year fixed rates are at, which are at 3% right now. 15 years are in the mid twos. We're financing investment properties in the high threes. Jumbo loans are back. In the last 3 weeks, we've seen Chase return to the market. Wells is still out until next year, but we've got a lot of jumbo investors back, and those rates with 20 to 25% down, 720 FICO scores, and you know, a debt to income ratio below 43 is what you need to qualify on jumbo. Those rates are in the low to mid threes on a 30-year fixed and the high twos on a 15-year fixed. So that's compared to high threes, mid fours 30 days ago. So the jumbo market has come back pretty quickly. It's still fairly illiquid. It's still pretty restrictive. There's no investment property purchases. There's no jumbo cash out refis. It's really for middle of the road purchases for primary residences or second homes, and rate and term refinances just to lower your rate. The Fed is talking a lot about the uncertainty in the economy. And as long as we have that and they continue to drive billions of dollars of bonds, they're going to prop up the market to keep rates low, I assume, through next year. This is going to take a while to recover from. So this is a great environment for investors, for homeowners to lower their current rate, to buy a new primary residence, which we're seeing a ton of. People have had a lot of downtime to think about things over the last few months and reanalyze and reset in terms of what their goals are, where they want to live, what they want to invest in. And real estate, especially in Austin, has been a pretty safe play compared to the volatility of the stock market. So we're going to continue to see growth in Austin. Appreciation has averaged around 6-7% over the last 10 years. It's going to continue, if not jump, over the next 12 months. So given that we strongly believe the stock market at current valuations is oversold and ripe for another correction, because basically the data is telling you now that the Dow is where we were back in January before COVID really hit. And I don't think that's really sustainable. So as you know, the bond and stock markets work inversely. So if the stock market falls, the bond market will rally and rates will possibly drop even further. They may be at as low as they can realistically go. The banks still need to make a little bit of money. But with 30-year fixed rates around 3 and a 15-year at 2.5, that is some pretty cheap money to finance debt. As far as the underwriting process goes, the return of multiple offer situations and a lot of demand with low inventory has created another buying frenzy of what we're seeing now, kind of like we had last summer and fall. We're turning around purchases in about 3 weeks right now. If the property doesn't need an appraisal, and if it needs an appraisal, it's at about 4. Construction loans just came back. And now that jumbo and construction are back, we're pretty much back to normal operations. There are a few new conditions that COVID has brought to the table, really affecting those that are self-employed. If you've done a loan and you're self-employed, you know what I'm talking to, and you're probably laughing right now. They make it a little harder. But the beauty of self-employment is you get to write off your income. And the hard part is when you go get a loan, you have to use that income to qualify. Including year-to-date P&Ls and balance sheets. Well, Fannie Mae and Freddie Mac have required that you provide either audited financials from a CPA or unaudited financials with 2 months of business bank statements to back up the cash flow. Well, they're asking for this at a time when many self-employed businesses are down or declining year-to-date, so they have an out to decline the loan. So that's presented a few hurdles, and then we have to verify employment on the day of your purchase closing or a refi closing to make sure nothing has changed since the loan originated. So those are the main changes, and we're still getting a lot of property inspection waivers, meaning appraisal waivers on conventional purchases. If you've got a decent down payment, the software will just kick out an appraisal waiver, which means if you don't need an appraisal, it saves you $600. And it saves you 2 weeks. So those are the deals we're turning on really fast right now. And we can determine that in the option period, which greatly improves things and our chances of staying on time. So that's sort of the 101 on current lending. We're incredibly busy with a huge volume of refinances. And now that purchases have come back, I think we're going to be back to the numbers we've been used to seeing in Austin growth, just based on how often your phone rings is always a good barometer. And I'm really happy to see things come back in the purchase side of things. We'd always rather be working on purchases than refis, which are kind of low hanging fruit. They'll always kind of be there. A lot of people have already refinanced once, twice, 3 times. I had one client that's refinanced 7 times, even though I try to talk them out of it. There are serial refinancers out there, but the purchase market is incredibly strong, and we're happy to help anybody that wants to do a pre-approval for an investment purchase in Austin or nationwide. We lend across the country. And to do a pre-approval, you can just go to zanderblunt.com and click apply now, and we'll reach out to you as soon as we can.
Thank you for saving me.
Of course. Well,
Yeah.
I had to relaunch Zoom to get it to, I had to upgrade to the new version. So
Yeah, I really need a new
it was a
computer.
perfect handoff because mine
Yeah, it was
wasn't working
great. It
well.
was kind of a dramatic,
High five.
just a dramatic ending. So I appreciate you.
Of
Yeah.
course.
All right. Awesome. Well, I kind of missed the first thing you said, but I know you always say smart stuff. So I appreciate you being here and being a partner and all that good
Of
stuff.
course.
Yeah. All right. So let me hop back on my slides here. Let's see if I can remember where I was. Oh yeah, talking about opportunities, talking about forbearance. Yeah. What do you know about forbearance? Anything to add on that?
Yeah, forbearance is something you completely want to avoid. It will cost, I mean, just don't do it. Like, find any way to pay your mortgage. Don't do a forbearance. It
Yeah.
does go on your credit. It will lower your scores. They can't legally hold that against you. It won't show up as a late payment, but it does show as a forbearance and sinks your scores. So just avoid it is my short recommendation.
Yeah. Well, and for those of you that are here for the investing side of things, it's my understanding there's about 5 million homes that have filed for forbearance now nationwide. And, if you're a realtor, obviously you want to be educating your clients about forbearance and really telling them the ways not to do that because, like Xander said, it's detrimental to your credit. You're probably going to you might lose your house. You don't know what kind of terms you're going to get. And if I know anything, the banks never lose and the banks always win, right? And so definitely avoid that at all costs. And so, in addition to people who are applying for forbearance and putting their sort of house in jeopardy, we also have I don't want to say opportunity. That doesn't sound nice, but there will be people who are losing their jobs. I've read some estimates that up to 50% of American households will have a drop in up to 50% of their income, which basically means half the households that have two income earners, one person's going to lose their job. And that's pretty significant. I know those of us that are in Austin, Texas aren't necessarily seeing that, but there's a lot of communities out there that have been very hard hit. And once, if the extra $600 that folks are getting for unemployment, if that goes away, there's going to be significant decreases in income, and that means people may not be able to make their mortgage payments. It's not going to happen. Those deals aren't going to be popping up in the next month, 2 months, probably even 3 months. But unless we get a vaccine here pretty quick, we're probably going to be kind of seeing this open and close, open and close, open and close for the next year. And so some of these things that have longer term ramifications are going to be popping up. And we're going to see some of that in the housing industry. So I did have a slide here on forbearance. This is actually from the National Association of Realtors, and you can see the total forbearance loans. So way back in March, March 2nd, we've got a 0.25 percentage of households that are applying for forbearance. And then fast forward to May, we've got about 8%. So that's a massive jump, 8%. And this is actually, these only reflect Fannie Mae and Freddie Mac loans because that's who are being granted forbearance. But obviously that's a huge jump, and we've only got numbers through the 1st of May, and I suspect that there's even more people who were probably unable to make their June payment, so probably going to go up. Yeah. The good news is it's not as bad as everybody thought it was going to be. Even though this looks bad, I think some people thought it would be a lot worse. So good news, bad news. Okay, so U.S. commercial market. Here's another opportunity. So this is something that Jay and I have been wanting to do, my husband Jay and I've been wanting to do, which is to do some commercial investing. And for those of you out there who, really all of you understand what's happening in the U.S. commercial world, we've got restaurants who are going out of business, right? I know I personally am driving around in my neighborhood and I've seen more for lease signs along, I live in South Lamar and kind of central Austin than I've ever seen in my life for commercial buildings. And I feel certain that's happening across the country. So if you look at that chart on the right, that's May 2020 year over year change in deal volume. Okay, so starting at the top, we've got industrial down about 70%, apartment deals down about 80%, office 80%, retail 80%, and then hotels 80%. I think I read there, and this is deals $2.5 million and greater, so these are pretty big deals. And I think I read that the only 17 hotel deals transacted in May, which is it's a very, very small amount. And if you look at that chart on the left, you can see that's just historic lows. So I personally think that's where a lot of opportunity is going to come. So if you have been interested in maybe trading up, thinking about buying a commercial building, just you wait. There will be deals to be had as restaurants are unable to pay their bills, unable to pay their rent, as retail is unable to pay their bills, unable to pay their rent. Some of these landlords are not going to be able to keep their buildings any longer. I know a good friend of mine, she told me she owns a lot of commercial property in the kind of the DC, Baltimore area. And she said only about 40% of her tenants have been able to pay. So,
Wendy, we saw a similar drop in 2009
mm-hmm.
when the mortgage market collapsed. And I know a lot of Austin investors, we do residential lending, but through Plains Capital and other commercial banks we work with, we've seen a lot of our clients invest in commercial buildings, and the rate of return they've received in the last 10 years since that crash is staggering.
Yeah.
300-400%, and you're talking a large capital investment. So
yeah.
Obviously it takes a little more skin in the game to jump in that market, but if you have that access to the liquidity and capital to get in the commercial game, the returns are obviously far greater.
Yeah, of course. Well, any investment is going to require some risk, right? There's no such thing as an investment that requires no risk, and then the greater the reward, typically the greater the risk, and usually the deeper pockets. But I'll tell you guys that most of the real massive wealth in this country and in other countries is people who own businesses and people who own real estate, but mainly commercial real estate. So if this is an option for you, if you've been thinking about dabbling, if it might be a great time. Even I think about us, we own a lot. We own a lot of residential real estate that has not been cash flowing well, just because of the taxes that we've owned a long time. We have a lot of equity in our properties, and so for us, when the residential real estate market is hot, it might make sense for us to sell some of those properties and sort of double down and turn that money into a commercial investment. So that's kind of where we're thinking. I'm by no means a commercial expert. However, I think anybody has half a brain knows that the landscape is shifting, and it's been shifting for a while, especially the retail landscape. I think about some of these big box retailers who haven't really made the jump to online sales. I was reading about Lord & Taylor, right? They declared bankruptcy, and they about 75% of their business was walk-up clients, right? They just never made the leap to online sales, and the writing's been on the wall. Think about Toys R Us, right? The writing's on the wall for some of these retail things. So I think the commercial world is going to look real different in a couple of years.
Without a doubt.
Yep. All right, so let's see. I'm going to go back here into this slide. Yeah, so that's really the commercial. And then really, I think there's a lot of opportunity for single-family investments. Obviously, as if people are losing their jobs and losing their homes, there's opportunity there. I imagine, especially in some cities, there's a migration towards single-family homes and away from apartment dwelling. I know I had one of our investor clients ask me. She wasn't able to make it, but she was asking me if there were sort of people moving away from the central core in Austin and into single family homes. And I haven't seen a lot of that, although the condo market does feel a little flat to me. And then, I can't imagine where all those people in New York City are going to go, right? I know I have a friend who's the number one real estate agent in the bedroom communities outside of New York City, and she's never been so busy in her life because people are fleeing New York in droves and they're going to go somewhere, right? I don't know exactly where they're going to go, but they're going to go somewhere. All right, so we have our next special guest here. Leanne, are you here?
I am here. Let me start my video.
Yeah, let's see your video.
Can you see me?
Yes, hello, my friend.
Oh,
Yeah,
hi. I
can
can't
see
see
you.
me.
You can't see you? Oh, no, I see you. Yeah.
Hi, Leanne. We can see you.
Yeah,
Okay,
I can
great.
see you. Great. Well, so just as a quick intro, so Leanne and I have been partners for, several years now, and she has an amazing story. She's a marine biologist by trade. She grew up kind of, I don't know, in the woods in Alaska, basically, and she got a wild hair to be a green builder. And so she picked up her bags and moved to Austin, and now has one of the top green building businesses in Austin. So she's a total lady boss, and just someone I respect and admire for her integrity and work ethic and just all around amazingness. So she is going to talk a little bit about the building climate here in Austin specifically. I don't know that she's an expert. Maybe you can tell us a little bit about the building climate across the country. It's probably very similar. And then she's also going to talk to us about other ways to invest. So for those of you who are interested in maybe sort of that low risk investment, she's got an investment program that we personally have invested in, and some of our clients have invested in too. So I'll just let Leanne talk a little bit about kind of what's going on in the builder market.
Absolutely. Well, thanks for having me, Wendy.
Sure.
It's great to be here. Yeah, so what we're seeing here in Austin is builders. We were shut down for oh, now I can see myself. Let me adjust that.
There you go.
There we go. Not so high. We were shut down for a few days by the mayor in Austin. However, the governor stepped in and overruled, and so now we are still currently building and working in a safe manner. Less than 10 people can be on our job sites, and we have to wear masks and be safe and social distance and whatnot. It hasn't slowed us down too much. We did have, I guess the vendors did slow down a little bit, but nothing too big. We maybe had to get pushed back in schedule a little bit or switch vendors, but it hasn't been super detrimental. And lenders did stop, hard money lenders did stop lending to those flippers or smaller builders, but we are still building, we're still getting funding, so things are still working pretty smoothly for us. So there was a little bit of a slowdown. Some builders did slow down in construction or pause and stop.
Well, I know you had some supply chain issues too, a little bit.
A little bit.
Yeah.
Not huge on the supply chain, a little bit with the city of Austin and getting through inspections and Texas gas and whatnot.
Right.
So yeah, small delays. And then because some of the builders did decide to slow down or stop their construction, I'm almost wondering, this is just a question that I had, is possibly an early 2020 squeeze, 21 squeeze in the market, meaning that not as many new construction builds will be coming or hitting the market in early 2021 due to COVID. We didn't slow down, but I know that some builders did, and some builders did put a pause on it. So the demand is still up. We're still going under contract on homes. So that's great for us. And as far as our investment opportunities, what we do is we develop properties. So we buy the land and then we build a 5-star Austin Energy Green Build rated homes complete with solar panels on it. And how we do that is we actually use hard money in the first position, and then someone such as a private money lender or someone such as yourself in second position. And how we secure your investment is we use a promissory note, which is basically an agreement between me and the investors, so kind of making you the lender, you acting as the bank. And then we also use a deed of trust, which is actually recorded, and it secures your investment to the real estate. So your investment is actually backed by real estate, which makes it very appealing and relatively safe investment. And then we also add you to the insurance. So if anything happens, flooding, fire, whatnot, you will get paid out through insurance. So that's just an extra layer of protection for your investment. And right now we offer a 12% APR, and the note is written for 18 months, but you'll typically receive your principal and your interest back in about a year once we complete the construction.
All right, thank you. Well, like I said, we've invested with Leanne, and it's just a nice way if you've just got money. Minimum. What's your minimum investment?
Typically right now it's around 100,000.
Okay,
Yeah.
got it. Okay, awesome. All right, so let's talk about other opportunities for single family investing right now. So I would just preface this conversation by saying that at the end of the day, real estate investing is a get rich slow scheme. It's not sexy. It's not a late night infomercial. You're not going to drive around and see somebody's number on a sign and call and make a gajillion dollars. That's not what real estate investing is about. If that has happened to you, good for you. You're extremely lucky. But investing is a get rich slow scheme. So what I mean by that is really I counsel everyone to really think about their net worth and not their income. And so if you're thinking about, and just to kind of share with you what net worth is. So net worth is everything you own minus everything you owe. So all of your assets minus all of your liabilities. And that's a real formula for wealth, is to think about that and to track that. And that's why real estate is so amazing, because you can buy real estate you can leverage your money and buy real estate, unlike other assets. So let me give you a for instance. I tell my clients, hey, Zander, you've got 3 kids under the age of what, 8?
8.
Yeah. And how would you like to pay for college 20 cents on the dollar?
Yeah, let's do it.
Okay, great. Well, the way you do that is you contact my friend Zander at Prime Lending, and you can buy a real estate investment with 20 to 25% down.
Yep.
And you put it on a 15-year note. And by the time your son gets to college, and he's what, 2 now or something like that?
As those two.
He's 2. So by the time he's 17, complete strangers will have paid the 75% of that off.
Yeah.
Right?
And we quoted an investment purchase contract today, and 25% is the real sweet spot to get a really good rate. 20%, you're still looking at rates in the 4s, but if you
Okay.
just do an extra 5% down, the 30-year fixed rate was 3.875.
What about 15? Do you know?
It's about a quarter lower. There's not a big
Okay.
spread, but
Not a
you can
big
get it in
spread.
the mid 3s and even buy it down. So that's where purchase money rates were 6 months ago.
It's
Right?
unbelievable.
So
It's
it's that
unbelievable.
50, 75 basis point spread you would usually see between a primary and investment is basically eroded.
It's gone. Yeah. So it's a great time to buy an investment property. If you don't have 20% down, buy, and you don't have a home, right? You're not living in a home. Buy your first home, and it can become your first investment property. Jay and I bought our first investment property. We lived in it for 3 years, and it became our first. Then it became our first investment property. So unlike the stock market, so if I went to my stockbroker and I said, hey, I want to buy $100,000 of stock, but I only want to pay $20,000 for it, and I want to let other people pay the rest off over time. I mean, my stockbroker would laugh at me, right? So that's the real beauty of real estate investing, is you can really leverage your money. especially if you're young, right? I know there are some of you who are listening who are probably under the age of 25. And if you can make this first investment, buy a home, buy investment properties, buy this now, then honestly, by the time you're in your 50s, you can do whatever you want, or even sooner, honestly, in your 40s. So really think about that net worth, because a lot of people get hung up on the fact that they're only getting $100 worth of cash flow every month. So they say, listen, after I pay my mortgage, I pay everything, I only make $100 and I'm doing all this work. But you have to think about it. You're hopefully you're gaining equity in the property. Most markets in America are going up, but even if they aren't, complete strangers are paying your debt down for you. So at the end of the day, if you buy an asset for $100,000, you only have to pay $25,000 for it. Worst case scenario, right? And then over time, your tenants pay the rest off. So even if you're only making a little bit every month, if you can take the long-term view, real estate can be just the most amazing investment. And that's why, because you can leverage your money. All right. So here's just a quick rundown of where we should buy. So this is just our strategy, guys. I mean, you might have a totally different strategy based on who you are and your situation in life, but our strategy has always been long-term buy and hold. We live in Austin, Texas. Home prices have gone up unbelievably since we've lived here, and we bought a lot of properties in the 2000s. We typically buy areas outside the central core with good schools, just because they're a little bit cheaper, but we've always had great renters. And then I highly recommend 3-bedroom 2-bath, and then on a little bit smaller lot to save on the taxes, just because you're going to get more rent for it. We do have 2 properties that are 2 bedrooms, 1 bath, one of them which was our first home, and honestly the rent is capped. There's only a certain amount of rent that 2 people can pay. And then we like to buy houses that need a little cosmetic work but has a newer roof, a newer AC, and possibly a water heater, because those 3 things together can add up to about up to $15,000. So that's just our strategy. Lots of other strategies depending on where you are. I'm not going to talk about house hacking, but if you're young, house hacking's awesome. Go to Bigger Pockets and find out what that is. Buy a property, live in it, get tenants. But we've just really seen our net worth grow over the years with this kind of quick strategy. And
Wendy,
yeah.
one comment on the renovation option is, if you find an investment or a house that doesn't have a roof or needs a new roof or new plumbing or foundation, we have a purchase money renovation program where you can roll that into the purchase price at closing on a 30-year fix. So
love it.
You don't have to, you could save your cash and roll it into the loan.
Yeah, I love that. Well, and honestly, you make money by solving problems. That is how you make money in real estate. You make money by solving problems. So if it's a foundation issue, right, and you can get it for the right price, solve that problem, right? If it goes in, if you walk in and it smells like cat pee, guess what? That smells like money. Fix that problem and take advantage of it. And I'll just say that, it's always about price, condition, and location. And all those 3 things are different depending on what you're looking for and what your criteria is. And so I would just kind of end with saying that really I would encourage you guys to think about how to kind of get ready, set, go for the next year, because there will be opportunities. There might be more opportunities for investing than we see again in our lifetime. I don't know. A lot of people are saying it's probably the best opportunities we've seen in the last 15 years. So at least get prepared for it. First of all, save your money, right? Start cutting expenses if you haven't already. Talk with a realtor. You want to be in a relationship with a real estate agent, especially a real estate agent who kind of knows their stuff about investing. Start saving your money, and then do what I call get your investment criteria together. And what I mean by that is everybody has a different reason for investing. So for Zander, it might be that he wants to buy 3 long-term buy and holds for his kids, because he's got kids he's got to put in college. It might be that you're already 65 years old and cash flow is more important to you. Whatever that looks like, make a list of all your needs, right, for your property, and then get really tight about what you're looking for. So when I say investment criteria is like, I'm looking for a 3-bedroom, 2-bath, brick home in a good area that's at market price or slightly below, right? That's investment criteria.
And I like to use real data from contracts we're seeing come in for second homes and investment properties. And this has been the week of the lake properties. So we had 3 closings on Canyon Lake this week. We got 2 more Canyon Lake's blowing up. So get there before everyone else does.
Yeah.
Lake LBJ. So basically what COVID's done is it's made people want to have a place to get away to. And it's nice to have access to water. And those properties relative to Austin prices are pretty affordable and give you a place that's within an hour away. And since it's more than 50 miles, we can finance these as second homes, which have primary residence rates rather than investment properties. The only downside is you can't use rental income to qualify, but you can still use a second home just like at an investment property. And you only need 10% down rather than the 20 or 25%. So the opportunity doesn't necessarily need to be in the city you live. It can be in the surrounding areas. And Wendy's team has agents that work that whole area.
Yeah, we work the whole area. Yeah, I love to hear you say that because we did put a property that was for sale on the lake. It's had like 36 showings or something. It's over $1 million. So I'm not surprised to hear you say that. And then really kind of get your ducks in a row. So get pre-qualified. It's not super easy to get pre-qualified. It's not super hard, but
it's easy. It takes 15 minutes.
Not for me.
Credit income.
I'm scared.
Easy.
No, my tax return is like that.
I love those.
So, okay, it's super easy. So go ahead and do it. Maybe 20 minutes, right? 15 minutes. Yeah. If you're really smart, it's like 14.3.
There's only one way to find out how long it takes.
That's a challenge. And if you need cash, think about a cash out refi for some of if you've got a property, think about getting a home equity line of credit, all of that stuff. Because what happens is the opportunity is going to come along and you got to have the cash for it. That's what Ready and Set are. You got to have the money. And if someone comes to you with an opportunity, you don't have the liquid cash, then guess what? You're not going to be able to take advantage of it. So make sure you get your ducks in a row there. And then don't wait, don't wait for another 15 years. Don't wait for something better to come along. You can never know when the bottom of the market is, right? We just don't know. It's impossible. Actually, kudos to my, I have I don't know how old she is. She's 23 or 24 years old, gal on my team. And when COVID hit, her price point's pretty low for Austin. It was around 200,000. And when COVID hit, instead of putting her head in the sand, she jumped on it. And not only did she get a house that would have had multiple offers normally, she actually got the seller to pay $6,000 in closing costs, which on a $200,000 house is kind of unheard of. So good for you, Kim, if you're listening. You just don't know when the bottom of the market is. So take it. If it looks like a deal and smells like a deal, then go for it. Interest rates always matter. They always matter, probably the most, more than getting a discount on price or anything like that. And we are looking at just unbelievably low interest rates in the 2s, 10% down on a lake property that you can use in investment. I mean, it's crazy out there. And then there's just always good deals in any market, right? So no matter what, even if we don't see a decline in home sales, it's, they always say the best time to plant a tree was 30 years ago, and the next best time is today. So, and then I'll just close with this quote from Warren Buffett, who's probably one of the smartest and certainly wealthiest people that any of us have ever known. And he just says, be fearful when others are greedy and be greedy when others are fearful. And, wealth can affect your family for generations in a positive way, and money is good for the good it can do. So just get out there and take advantage of those investing opportunities that come along your way in the next year. All right, so I'm going to stop sharing my screen here for a minute and see what's going on in the chat box. Does anybody have some questions that they want to throw at me or at anyone?
Diane had a question about jumbo in terms of underwriting and qualifications.
Mm-hmm.
I would say it is a little harder. You need an appraisal on every jumbo loan, so you're not getting a waiver. We typically want a 30 to 40 day close on jumbo. We can turn around them faster if needed. but you really just want middle of the road, 20-25% down. 30 to 40%, you're going to get an even lower rate. So if you have a big down payment, these deals are skating through underwriting pretty fast. It's where if you're doing minimum down and you have borderline FICO, the underwriters are going to take a very close look at it, especially the appraisal. So 720 FICOs, 20-25% down, can't hit over 43% DTI. Pretty much all 30 and 15-year fixed. The fixed are better than the ARMs now. And we've got 4 or 5 jumbo investors back. So as long as it's a property you should qualify for, then it's not an issue. If it's something you probably shouldn't be buying, and you're getting talked into it because your wife's been at home on realtor.com app trying to like move out of their
Or
house.
your husband, Diane?
Get me out of here. I need to go buy something. Well, it may not work. So what we are seeing is a lot of those jumbos in the 600 to 800 range is you can avoid jumbo by splitting it into a first lien capped at the conventional limit of 510, 400 into a second lien for 100 or even 150, 200 grand. So that gets you around jumbo if needed.
Lots of options. All right, Jacob has a question. What are your thoughts on paying down a mortgage early versus making normal payments and saving up for another property? Great question. And along with that is, we've always put our properties on 30-year notes, even though we've always paid them off early. So the nice thing about the 30-year note is if you're in a global pandemic and some of your tenants aren't paying rent, then that little extra cash flow can help you, right? Your mortgage payment's a little bit lower. And then paying down a mortgage early, I mean, I'm all for that, right? Like the closer, the more you can get to financial freedom, the better. However, if your goal is again, you're young, right? So the advantage of you paying off your mortgage in the next 10 years is probably, you may not need that income in 10 years. You might be working. So it really just depends on your goals, what you want from your properties. Yeah.
Wealthy investors have gotten more wealthy by leveraging debt in a smart way. And right now with record low rates, the best way to use that money you have is for a down payment on additional properties. So the more you can scale up your real estate portfolio to get 2, 4, 6, 8, we can finance up to 10 properties. Even if you just get the minimum down on each of those and have someone else start paying them off. I like that approach, but it's hard to talk someone out of paying off a mortgage. There's a reason.
Yeah.
That
I mean, Gary
off.
Keller would tell you to pay off your home. He would tell you to pay off your home, but then he would say leverage everything else.
Right.
So, but again, it depends on your goals. So, okay, let's see. All right, Lisa says, I'm closing on a beach property July 10th and paying off a new vehicle. Planning on flipping a property or 2 to gain that money back and continue with flips if I can make $30K on each property for a bit. Recommended. Well, so, I've always been a long-term buy and hold gal. I just feel like flipping can be great to kind of get you started. However, most people I know who do a lot of flips, they spend a lot of time. They spend a lot of time on the flips. So, I mean, Warren Buffett says the best time to sell a good asset is never. So that's just my thought.
I think it's harder to squeeze out the margins we saw in flips maybe 5-7 years ago. There's more people doing it. It's sort of like renting your house on Airbnb. I have a house in Hyde Park that we used to make a lot of money on, but now there's so much inventory to rent short term, the demand in rent has gone down. I think flips are a similar thing. A lot more people are doing them. There's a lot more investor demand to where lot prices have gone up, building costs have gone up. And to me, personally, I think it is a lot of work and a lot of stress for a minimal return on flips. I see people do them. I applaud them. Well done. But, I'm with Wendy in that a longer term hold makes more sense.
I think if it's your hobby, if you're passionate about it, if you love going in and fixing up old homes and it's your hobby, and your hobby at the end of it, after all that work, pays you $25,000, good for you. But I mean, there's a lot easier ways to make $25,000 in this world, especially if you're in real estate.
Yep.
You know, in our market, that's just a couple of closings, and you know, everything I know about flips, it's a lot more work than that. So, all right, Aiden says you might have already covered this, but what do you think the optimal percentage to put down on a property as a down payment?
Well, with rates so low, we're seeing a lot of people that could put 20% down to avoid PMI are doing 5, 10, or 15% down to preserve their cash. Right now with COVID, a lot of people want to have a nest egg. So if rates are at 3%, you can likely make a better rate of return on your money if you don't invest it in the property. It's not going to change your monthly payment a whole lot to do less money down. You'll only have PMI for 1 to 3 years, if that. So we're seeing people finance a little bit more. Conversely, if it's a multiple offer situation with 7 offers, like Lost Creek is probably the craziest neighborhood to try to buy in Austin, or maybe Travis Country, where people are banging on doors and there's 20 offers and the seller just takes their pick. You have to show, you know, a bigger down payment. But if it's not going to hurt you from getting the property under contract, the rates don't change. In fact, the rates are often terms are better at 5, 10, or 15% down than with 20% down, because the banks want that mortgage insurance policy behind it. So the rates are the same whether you do 5, 10, or 15% down, and they're a little better than 20. So minimum down is certainly not an issue right now, and a lot of people recommend it.
Yeah, I love that. Okay.
That's for
So,
primary residence or second home. Investment, I recommend 25% down.
yeah,
You're gonna have a lower monthly payment, cash flow better, and get a better
right,
rate.
right. Yeah, exactly. Well, and in Austin, it's pretty much impossible to really even put less than 25% down and have it cash flow. It's just tough,
Right.
even in the burbs. In some cities, though, it's very possible. Just not in this area. Let's see. So somebody said, take a couple more questions. Do you use a formula like 70-30, or as long as you break even or cash flow and meet the other 3 requirements, you buy it? So yeah, I think for me, if it cash flows even a little bit, then that's all that you care about. I mean, honestly, you could buy a property at the right price and have an interest rate of 25%. And if the property cash flows and somebody else pays the debt down, then who cares? Right? At the end of the day, it doesn't really matter. I mean, obviously that's a terrible interest rate, but if you could set it up that way and it still cash flows, so it's really all about the numbers. And that's how I always look at it, especially since we don't need the income right now. You know, our goal is just to pay off the properties and then someday live off that income. But right now we don't need the income. So I would never buy a property that did not cash flow, expecting it to appreciate or expecting rents to rise. I just wouldn't do that. It's just a bad philosophy. So, all right, guys. Well, it's 5:02. So I want to thank Zander from Prime Lending, zanderblunt.com, and Leanne Wortman from Fortunate Foundations, fortunatefoundations.com, for joining us today. Thank you for saving me, Zander, when my computer crashed.
Of course.
And I appreciate you guys all for joining in, and all of those that are watching on Facebook Live. We thank you too. So until next time, we'll be doing this again probably every couple months, just to give you guys an update of what's going on in the market and information on where the deals are and all that good stuff. So stay tuned.
All right. Thanks, Wendy.
Bye, guys.
Take care.